Hi everyone, today we'll be going over accounts October-November 2021, paper 2-3, question number 2. This is structured paper 2, which consists question of 90 marks, and we also have a time limit of 90 minutes. And since question number 2 is of 15 marks, we will be attempting to solve this question under 15 minutes. So without any further delay, let's get started. Abby, Ben, and Ken have been in a partnership for many years, sharing profits and losses in the ratio 3:2:1. So out of 6 portions, 3 belongs to Abby, 2 belongs to Ben, and 1 belongs to Ken. Then the partnership's draft statement of financial position at 30 June 2021 is also given below. Then we are given the information that Ben retired from the partnership on 30 June 2021 and the following was agreed. So these are the terms on which Ben retired. Any amounts due to Ben were to be transferred to a short-term loan to be repaid from the partnership bank account within 1 month. So whatever amount that the business owes to Ben will be treated as a loan rather than paying it to him right away. Then Abby and Kane decided to continue in partnership, sharing profits and losses in the ratio 3:1. So previously the profit sharing ratio was 3:2:1 for 3 partners. However, Ben retired. So now Abby and Kane will maintain the partnership with the profit sharing ratio of 3:2. Kane agreed to pay sufficient funds into the partnership bank account so that the partners' capital account balances reflect the new profit sharing ratio. Alright, this is the information that we will use in the questions below. Now for the first part, we need to state one reason why a partnership may revalue assets on the retirement of a partner. The main reason to revalue assets on the retirement of a partner is to make sure that the retiring partner gets a fair share of the up-to-date value of the net assets. So let's write that down. To make sure that the retiring partner gets a fair share of the up-to-date value of the net assets. Alright, this concludes the first part. Now for the second part, we need to prepare the revaluation account at 30 June 2021. So the very basic concept of revaluation account is that whenever there is an increase in the value of the assets, that increment is recorded on the credit side, whereas the decrement in the value of assets are recorded on the debit side. So let's have a look at the information regarding the revaluation of asset. So the first one is that Ben should retain one of the motor vehicles at the net book value of 14,500. Alright, then the remaining motor vehicles should be revalued at 33,000. So the new value of the motor vehicle is just going to be 14,500 plus 33,000, right? And previously the value of the motor vehicle was 52,000. So let's just figure out the total for the new value of motor vehicles first, which is 14,500 plus 33,000, which is 47,500. So obviously we can see that there is a decrement in the value of the motor vehicle. And like I said before, the decrement in the value of assets should always be recorded on the debit side. So let's record this value of motor vehicles. Alright, we need to figure out the difference. So previously we had the value of 52,000 and the new value for the motor vehicles was found to be 47,500. So this difference is of 4,500. So the decrement in the value of motor vehicles is actually of 4,500, and this is the value that we need to record in our revaluation account. So let's write it down right here. Okay, now we can move to another asset. We're given that the property should be revalued at 77,000. So this is a new value of property. Let's have a look at the old value. So previously property was revalued at 65,000. So we can clearly see that there is an increment in the value of property. Let's figure out the increment value. So that's going to be 77,000 minus 65,000. This gives us the value of 12,000. Again, like I said before, increment in the value of assets should always be recorded on the credit side. So we will be recording this amount of 12,000 in the credit side under the heading of property. Let's do that. So we have 12,000. Alright, we can move to another asset now. We're given that the inventory should be revalued at 17,000. This is the new value. Let's have a look at the older value. So previously inventory was valued at 18,200. So we can clearly see that there is a decrement in the value of inventory. Let's figure out the decrement value. That's just the difference between the new value and the old value. So that's 18,200 minus 17,000, which gives us the value of 1,200. Again, there is a decrement in the value of inventory, which means that this amount of 1,200 should be recorded in the debit side under the heading of inventory. Let's do that. Alright, let's have a look at additional information again. Then we're given the information relating to goodwill. So the value of goodwill is actually not recorded in the revaluation account, so we can just completely skip it. So the only items that need to be recorded in the revaluation account are these three: motor vehicles, inventory, and property. Now we need to figure out whether there was a profit on revaluation or loss on revaluation. In order to do so, we need to figure out the total for both of these, the debit side and the credit side. Let's total the debit side first. So that's going to be 4,500 plus 1,200, which gives us the total of 5,700. And for the credit side, the total is going to be 12,000. So we can clearly see that the heavier side is the credit side, which means that the balancing figure should be on the debit side. And in the context of revaluation account, whenever the balancing figure is on the debit side, that indicates a profit, right? And since we're talking about revaluation account, we can just mention it as profit on revaluation. And this profit on revaluation needs to be divided among the three partners. So that's Abby, Ben, and Kane. Okay, let's first write down the total. So the heavier side's value is actually going to be the total value, which is going to be 12,000. Now, in order to figure out the balancing figure, we just need to subtract all of these amounts from the total amount. So that's going to be 12,000 minus 4,500 minus 1,200, which gives the balancing figure, or the profit on revaluation, to be 6,300. Now we need to divide this 6,300 among the three partners, Abby, Ben, and Kane, on the profit sharing ratio of 3:2:1. Alright, for Abby, that's going to be 6,300 times 3 divided by 6, because out of 6 portions of the profit, 3 belongs to Abby. For Ben, that's going to be 6,300 times 2 by 6. And for Kane, that's going to be 6,300 times 1 by 6. So for Abby, that's going to be 6,300 times 3 by 6, which will be 3,150. For Ben, that's 6,300 times 2 by 6, which will be 2,100. And for Kane, that's 6,300 times 1 by 6, which is 1,050. Alright, this concludes the second part. Now we can move to the third one. For the third part, we need to prepare the partners' capital accounts at 30 June 2021. So whenever we're preparing partners' capital accounts, we start with the capital balances. So let's have a look at the capital balances that is given in our above information. So capital accounts is given right here. So for Abby, the balance is going to be 60,000. For Ben, that's 40,000. And for Kane, that's 20,000. So let's write it down. And since we're talking about the capital, the opening balance is always recorded on the credit side. So let's write it down. We can just write it down as balance brought down. For Abby, there was 60,000. For Ben, that was 40,000. And for Kane, we had 20,000. Alright, a thing to remember here is that Ben is retiring. So we need to actually figure out the total amount that the business owes to Ben, right? And in order to do so, we should also include Ben's current account balance. Let's do that. So current account for Ben is given right here. It's 3,250. But we can see that it's given in a bracket, which indicates that this is the amount that Ben owes to the business, right? And we need to subtract this amount from the capital balance for Ben. So that obviously decreases the capital balance, and the decrement in the capital balances are always recorded on the debit side. So we can record this current account balance on the debit side. So we can just write the heading as current account. And we are only going to mention the balance for Ben since he is the only one retiring. So that's 3,250. The next thing that we can write in our capital account is the profit on revaluation, which we figured out above. So profit obviously increases the balance on capital account, and the increment factors in the capital accounts are always recorded on the credit side. So we can just record it as revaluation profit. Let's have a look at the amounts. For Abby, it was 3,150. For Ben, it was 2,100. And for Kane, it was 1,050. So let's record it. That's 3,150, 2,100, and 1,050. Nextly, we are also given information regarding goodwill. Right here, the value of goodwill was 39,000, and it was not to be retained in the books of accounts. But we need to mention this goodwill in our capital account. And why we need to do so is because we have two different profit sharing ratios. One where Ben was still a part of the partnership, and another when Ben retired from the partnership. So we need to actually divide this amount of goodwill among the three partners on the basis of previous profit sharing ratio, and among the two remaining partners, Abby and Kane, on the new profit sharing ratio. So the old ratio goodwill is to be recorded on the credit side, and we know that the old ratio was 3:2:1. So the old goodwill for Abby is just going to be 39,000 times 3/6. For Ben, that's going to be 39,000 times 2/6. And for Kane, that's going to be 39,000 times 1/6. So that's just going to be 39,000 times 3/6 is 19,500. 39,000 times 2/6 is 13,000. And 39,000 times 1/6 is 6,500. So we can just record it on the credit side under the heading of goodwill. So that's 19,500, 13,000, and 6,500. Now we again need to record a new goodwill on the basis of new profit sharing ratio among Abby and Kane, which is 3:2. So that's just going to be 39,000 times 3/5 and 39,000 times 2/5. So for Abby, that's going to be 39,000 times 3/5, which is going to be 23,400. And for Kane, that's going to be 39,000 times 2/5, which is going to be 15,600. So we'll record these amounts on our debit side under the heading of goodwill. For Abby, that was 23,400. There is no goodwill for Ben since he already retired. Then for Kane, that's going to be 15,600. Let's have a look at the additional information to make sure that we did not miss anything. Okay, the very first one. Ben actually took one of the motor vehicles at the net book value of 14,500. So he needs to pay this amount into the partnership account, right? And while paying amount, it obviously decreases his capital account balances, and the decrement in capital account balances are to be recorded on the debit side. So we can just record this amount of 14,500 on the debit side of our capital account under the heading of motor vehicles. Let's do that. So motor vehicles. And only Ben took the amount, and that's going to be 14,500. All right, let's have a look again. So, okay, Kane agreed to pay sufficient funds into the partnership bank account. So he is actually investing amount into the partnership account, which means that he's increasing his capital balance, and the increment in capital balances are always recorded on the credit side, so that the partner's capital account balances reflect the new profit sharing ratio. So the new profit sharing ratio of 3:2. So the closing balances of Abby and Kane should be in the ratio of 3:2. And in order to do so, Kane is actually injecting amount into the partnership bank account. So we can just record it on our credit side as bank, and we need to figure that amount. So that's going to be bank, and only Kane is injecting the amount. And this will act as our balancing figure. All right, this concludes all of our information, so we can just figure out the total. Let's do that for Ben first, because we know that the closing balance, or the amount that is owed to Ben by the business, is to be recorded as a short-term loan to the partnership. So let's just figure out the total for the credit side. That's 40,000 plus 2,100 plus 13,000, which is going to be 55,100. That's going to be the same for debit side. And our balancing figure is just going to be loan. And whenever we're trying to figure out the balancing figure, we just subtract all of the amounts from the total amount. So in this case, that's going to be 55,100 minus 3,250 minus 14,500, which is 37,350. Now we can figure out the closing balance for Abby and Kane. We can just write it down as balance CD. Okay, let's first total the credit side. For Abby, that's going to be 60,000 plus 3,150 plus 19,500, which gives 82,650, which is going to be true for debit side as well. Again, the balancing figure is going to be balance CD, and in order to figure out the balancing figure, we just need to subtract the amounts from the total. In this case, that's going to be 82,650 minus 23,400, which gives 59,250. So this is the closing balance for Abby, and we require the closing balance for Kane such that the closing balances for Abby and Kane are in the ratio of 3:2. Okay, so I'm just going to form a little equation here. Alright, so the closing balances for Abby is 59,250. We need to figure out the closing balance for Kane, and this should be in the ratio of 3:2. We can just write it down in the form of fraction. So that's 59,250 divided by Kane equals to 3/2. Now in order to figure out the value of C, that's just going to be 59,250. The division here goes as a multiplication, so that's into 2, and the multiplication here goes as a division, so that's by 3. So the closing balance for the Kane's capital account is just going to be 59,250 times 2/3, which is going to be 39,500. So we can write it down as the closing balance right here. Alright, so in order to figure out the balancing figure of bank, we first need to figure out the total for the debit side, and that is 15,600 plus 39,500, which gives the total of 55,100, which is to be same for the credit side. Then bank is just the balancing figure now, and in order to figure out the balancing figure, we just need to subtract the above amounts from the total. In this case, that's going to be 55,100 minus 20,000 minus 1,050 minus 6,500, which gives the bank to be 27,550. So Kane actually invested 27,500 into the partnership's capital account so that the closing balances of Abby and Kane will be in the profit sharing ratio. Alright, so the last part we need to do is to write down the closing balance as the opening balance for the new accounting period. So that's going to be balance BD, and we'll have the same balances of this row. So that's 59,250 for Abby and 39,500 for Kane. Alright, this concludes the third part. We can move to the fourth one. We're given additional information. Ben has indicated that he may be willing to leave 10,000 as an interest-free loan, but he requires any other amount due to be paid within 1 month. In order to maintain sufficient working capital, Abby and Kane are considering two options to finance the settlement due to Ben. The first one is to request an overdraft facility from the bank, and the second one is to ask Ben to consider leaving the whole amount due as a 5% loan repayable over 10 years in equal annual installments. And we need to advise Abby and Kane which option they should choose to finance the amount due to Ben. Okay, so the first option is to consider an overdraft facility from the bank. So overdraft actually serves as a pretty good option for temporary working capital. We can write that down. Overdraft serves as a good option for temporary working capital. But we can see that the settlement is to be done over 10 years. That's a very long time, right? So the settlement is a very long-term commitment. So the bank may not agree to the overdraft because overdraft is supposed to be for a very shorter period, and 10 years is a pretty lengthy time. So let's write that down. Settlement is a longer term commitment. So the bank agree to an overdraft. Nextly, we will ask Ben to consider the whole amount due with a 5% interest rate. So considering an overdraft facility over 10 years, that would be more expensive compared to the 5% interest rate on loan, right? So we can write that down as well. The 5% interest rate on loan from Ben is likely to be less expensive than the overdraft interest rate. Okay. Then there's also the question of whether Ben would agree to leave the full balance as loan or not, because he requires the amount to be paid within 1 month, right? So that is a questionable thing. Would Ben agree to leave the full balance as loan? Okay, considering these factors, we can see that the time limit of 10 years is pretty big for an overdraft. So personally, I would make the decision to choose option 2 in order to finance the amount due to Ben. So let's write it down clearly. So the decision would be that Abby and Cain should choose option 2 to finance the amount due to Ben. Alright, this concludes the fourth part as well as this question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.